Guys, everyone is saying that the U.S. China trade war is an absolute disaster, but honestly, I think that's only half the story. When I looked at the data, the numbers actually say something a little bit different, and I'm not here to give you some rah-rah America or some gloom and doom extremes. I'm here looking at the data and the facts. I'm going to share some of the potential big winners and losers and what the outcome could really look like. Now, on April 2nd, President Trump declares Liberation Day, announcing a 10% universal import tariff and an additional 34% tariff on Chinese goods, citing economic nationalism. On April 3rd, global markets plunged, with the Dow futures dropping 300 points as investors brace for inflation and supply chain shocks. April 4th, China vows retaliation, warning of no winners in trade wars, and prepares sweeping countermeasures. And then April 5th, the U.S. 10% blanket tariff takes effect on nearly all imports, excluding Canada and Mexico, which raises costs across retail and manufacturing. Now, as days go on, there's this back and forth. Back and forth. The uncertainty drives markets wild. Now, of course, my belief is that was the spark in the room. That was the excuse for it. Guys, we're going to look back on these days and go, wow, what a crazy ride. Dow's up 10%, down 7%. I mean, it was just insane, right? Now, of course, the Dow dropping prompts Trump to reverse course for allies, pausing tariffs on all but China. But April 10th, keeps going, raises the effective rate of 145%. China responds the next day. Guys, this goes back and forth, back and forth. All of this happens within an 8 or 9 day period. Literally one day we're like, oh, everything's okay. Next day it's like, oh my God, everything's terrible. Now, our Congress, April 16th and 17th, tried to sit there and introduce a bill that could curb Trump's emergency tariff powers amid domestic backlash. Now, and both nations remain locked in a tariff standoff. U.S. at 145%, China at 125%. Inflation's starting to take its toll and starting to increase. Guys, Trump has done a 180-degree turn on his tariff policy and softened it significantly. And many think it's because he saw the markets in turmoil and did not want to be attached to it. And others are saying it's because his advisors have advised him properly. I don't know how true that is, because he seems to not listen to advisors, and that's not an attack on him. It's just the reality. Or it could be the fact that maybe his tariff scares did work and it got people to fall into place. I truly believe that China needs us significantly, and even though we need them immensely, a big chunk of their economy relies on us, and we buy a lot of goods from them. And I don't agree with this tariff policy in general, but it is pretty clear that it scared a lot of people. Now remember, just because the markets fell does not mean it was direct because of the tariffs. I truly believe that it was the spark in a room filled with gasoline that caused this issue. Whether it was tariffs or something else, we've said long ago and many, many times that markets fall for a myriad of reasons, and the next big fall will be from something we probably don't see. Guys, trade wars are a lesson in emotion, politics, and long-term pain. Let's go back to 1930. Picture this. The U.S. economy just got body slammed by the stock market crash of 1929, and politicians, in their infinite wisdom, thought, hey, let's raise tariffs on thousands of imports to protect our industries. Now, guys, this is a time when manufacturing was still a huge part of our economy. Boom, the Smoot-Hawley Tariff Act. Classic emotional reaction. Countries fired back with tariffs of their own, and suddenly global trade collapsed. Instead of protecting jobs, we accelerated the Great Depression. That's like setting your kitchen on fire to kill a cockroach. Fast forward to the 1980s, Japan is absolutely killing it. They're cranking out cars, steel, electronics like it's nobody's business. The U.S., we're drowning in Toyotas. So we cry unfair trade and pressure Japan into export restraints and currency appreciation after the Plaza Accord. Short-term fix, long-term consequences. Does this sound familiar? Now, in fairness, Japan has really stagnated since the 1980s. But I think we'd all agree that 1980s Japan and 2020s China are very different. Now, guys, we've been hitting China with tariffs for years. And this is a thing that goes back to the first Trump presidency. Trade wars are emotional, they're politically driven, and they're rarely rooted in sound economic logic. Just like overpriced stocks during a hype cycle, when we let emotion drive decisions, whether it's in Washington or on Wall Street or on Main Street, we get inefficiency, we get pain, and we get lost value. As investors, we don't play the emotional game. We seek logic, we seek discipline, and we seek long-term thinking. Markets will overreact, and markets will do what they want to do. Politicians overreach, but investors, what do? We need to stay rational. That's the edge we have. Guys, let's cut the crap. Nobody knows who's going to win this U.S. China trade war. Not me, not you, not the politicians playing this game, not even the economists who sit there and guess. There are way too many variables. There are way too many egos and way too much global fallout to predict anything with confidence. I want to remind everybody what everybody thought would happen to real estate prices when interest rates went up. And guys, interest rates skyrocketed and they skyrocketed fast. And where have home prices gone? They continue to go up. But here's what we can do. Look what happens if China wins or if the U.S. wins. What are the ripple effects? Who benefits? Who loses? We're going to look at the potential winners and losers through the lens of principle-driven investing, which we preach on in this channel like crazy. So, if the U.S. wins this trade war, expect China to cave on big stuff. More U.S. imports, less subsidy, better intellectual property protection, maybe even tighter currency controls. Sounds a lot like Japan in the 1980s. U.S. exporters win, the trade deficit shrinks, and Uncle Sam flexes some geopolitical muscle. But let's not kid ourselves. That kind of win comes with pain. Both sides will bleed. Global trade will take a hit, and the ripple effects are absolutely real. So sure, there's upside for us in the short run, but don't forget the long-term costs. This isn't a clean victory lap. It's a bruised handshake at best. Now, if China wins this trade war, U.S. credibility takes a major hit, and China starts looking like a stable player, especially in Asia. And that's my big concern, that U.S. lawmakers now are past the point of return where that ego hit would cause too many problems for them to back down. Now, sure, some U.S. companies can get back into Chinese markets, but strategically, we lose a lot of ground. The U.S. would have to pivot, think about export controls, tighter alliances in order to push back. Meanwhile, China walks away with its economic model untouched, its tech ambitions alive and well, and a bigger seat at the global table. Now, guys, China already has a big seat at the global table. I'm a big believer that China economically will do much better than us in the next 20 or 30 years. This is just math. When they're so small economically per person, they can grow a lot faster. We are 6 times stronger per person economically than they are. Think about that. But they also have the fastest growing middle class, probably the fastest growing millionaire class out there. So the bottom line is both sides would take damage. But if China wins, they would walk off with that momentum. And that's the problem the investors need to understand, not just politically, but economically. Now, the U.S.'s hope is that China's loss is the game for some other country. All we're doing is kicking the can on the road for another country to get in a trade war with us at some point. There'll always be cheaper labor somewhere else. That's the benefit of being so strong economically. So guys, we've laid out this big picture. Let's talk about a real world impact. What industries could be hurt? So farmers. Guys, China stopped buying U.S. soybeans and prices tanked. Steel and aluminum, short-term winners, companies like Nucor and Alcoa caught a break. Autos, crushed. Ford, GM, Tesla. Tariffs made their U.S.-built cars way more expensive in China. And guys, we cannot ignore how big China is economically, for us even. Consumer electronics and retail, brutal. Tariffs drove up costs in everything from TVs to toys. Walmart and Target squeezed hard. Now, guys, there are lots of companies who would benefit and lots of companies would be hurt. Just remember, whenever something happens, it isn't always a hurt for everybody and it's not a gain for everybody. There's usually a winning side and a losing side. The question becomes, as a country as a whole, who gets hurt the most? So guys, here's my thesis here. Who could be hurt? These companies are definitely autos. Now, NVIDIA, as you saw, there's a lot of tariffs going on the chips there. Tesla, all these things get hurt. Alibaba would probably be hurt, and it's a company I own. But remember, Alibaba kind of still sells internationally. Yes, we are the biggest economic powerhouse in the world right now, but they still sell to other countries. Who could benefit? All these companies right here. Now, guys, there's always what ifs, what could happen, etc. These 20 companies, some could benefit, some could be hurt. We just talked earlier about how Walmart has been hurt temporarily because of tariffs, but in the long run, they could benefit from tariffs. Now, I made a short little spiel on each company, why they could benefit or why they could be hurt by the tariffs. You want to get that PDF, click the link below. I will email it right over to you. And guess what, guys? These are just general ideas. I'm not making any guesses about the future. All I'm saying is there's an argument to these. And guess what? There's probably an argument on the other side as well. But every company will adapt. In the short run, these companies could all benefit. But in the long run, my guess is that they will all account in some way and account for tariffs and end up being pretty much the same companies. But in the short run, click the link below to get the PDF where I explain why these companies could be hurt and why these companies could benefit from these tariffs in the short run. So guys, a company that I own that could be argued is going to be hurt by all these tariffs is Nike. But at the end of the day, I don't think Nike's going to be affected long run because I think they can go change it'll take time, but if these tariffs stay permanent, hypothetically, which are not going to be permanent, but let's say they're permanent, they would just change their manufacturing in another part of the world. Or even more likely is they would just increase their pricing and the consumer would pay for it. So let's go look at Nike and analyze it. And let's assume there's a permanent change in Nike's profit margin. I'm going to assume that their profit margin, and let's look at their profit margin here. This is our stock analyzer tool. This is where we blend the story and the numbers together. Their profit margin has hovered around 10% for the last 10 years. Okay, let's say it's like a big hit and their profit margin goes to 8%. Let me go to my recent analysis of Nike and change all of my profit margins to be, instead of 10, 11, 12, let's just make it 8 all across the board. Actually, let's make it 7, 8, 9. So what I did was I took their profits down 20%. That's a big number, guys. You might sit there and say, oh, it's only 2%. No, 20% of their profit being, because they're going to pass a lot of these costs on to consumers. The stock's currently at $54 a share. I've made other assumptions, 3, 5, and 7% revenue growth. PE of 20, 23, and 26. Okay, let's say they're not the leading company anymore. Now it's 17, 20, 23 in terms of my PE. I'm giving them a discount on that stuff too, which again, in the long run, I don't think should be done. Let's see how it affects the pricing. Guys, I saw this company in the green here in the middle assumptions. That's what I'm talking about. Margin of safety. The lower stock goes, the more margin of safety there is. I sat there and absolutely decreased their profit margin by over 20%. It decreased their PE by a chunk, and it still made the stock a reasonable buy today based on my assumptions above. This is part of the principle-driven investing. We want to have margin of safety because the future is unknown. We don't know what's going to happen with these tariffs, and we're humans and we make mistakes. It's really important when you look at companies that you understand when you're making your assumptions here, that your assumptions have appropriate margin of safety. Guys, I truly believe no matter who wins or loses this, I think the U.S. will be okay, and I think China will be okay in the long run. But a stronger China isn't just good for China. It's good for the rest of the world, including the U.S. More growth there means they buy more stuff from the U.S. It keeps supply chains moving. It lowers production costs for everybody and helps fight inflation by pushing cheaper goods worldwide. Commodities will boom because higher demand means higher prices, helping exporters in the US, Australia, and the Middle East. Yeah, there's inflation risk, but overall, a stable and growing China fuels global growth. We can't sit there and think we're in a zero-sum game, which means that if we gain, they have to lose and vice versa. That's not the way it works. There's a global pie that's growing. Our piece of that pie will be smaller as a percentage, but as the pie gets bigger, our piece gets bigger along with it. It's okay if we're not 50% of the world economy and we're 30% of the world economy, but the pie, that world economy is 5 times bigger. Do you understand that? That's really important. Don't have this xenophobic look at the world where we have to win in everything. Everybody else winning will make us better. Don't ignore China's impact. If they're thriving, it opens doors for smart investors who know where to look. So guys, in my opinion, this trade war is a temporary crisis, and it's not the long-term crisis that people are making out to be. I truly believe that we'll be fine. But while everyone's busy panicking about China, something else has been quietly building up. And if you're watching the markets right now, wondering what's really driving this pullback, you need to see this next video because there's a deeper strategy playing out, one that could reshape the economy, reset interest rates, and flip the markets on its head. So click the video on the screen and I'll show you what's really happening and what I'm doing about it. Thank you for your time.